Between calculated risk and reckless decision-making lies the dividing line between profit and loss. Charles Duhigg.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the retirement answer man, Roger Whitney.
Now, my mama used to tell me, son, you don't get something for nothing. And that is certainly true when you are investing. You do not get the potential returns that stocks, bonds, or cash might provide without giving up something. So last week, in that first part of this multi-part series of investing for retirement, we talked about what those asset classes have provided in average annual returns looking backwards. Well, now this week we have to talk about risk, the other side of the coin, what you got to give up for the potential of the returns of the capital markets. But we can't do any of that until we get to that all-important disclaimer. Boom, 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 boom. That's right. It's time for that all-important disclaimer. Now, we are going to talk about indexes today. You can't invest directly in an index. Did you know that? It is only a statistical model. It's not a thing you can invest in. We are going to talk about different types of investments. Did you realize that different types of investments have different levels of risk and they all might not be appropriate for you? We are going to talk about historical returns and historical risk levels. Did you realize that past performance does not guarantee future results? Yeah, I'm telling you that. It's in every document you've ever looked at, probably for investing. All of these things are still very important because we use them as a guide to build a framework to invest prudently. But before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Now, let's get to the hot topic of the day. Well, in the news today, risk is more sensationalized than ever before. Lately, we've had markets hitting all-time highs. The Dow, the S&P 500, the NASDAQ, I think the NASDAQ, I haven't looked at that one, hitting all-time highs. And if you turn on CNBC or Fox Business News or your local financial media, you will get told that they're hitting highs, but what you're probably going to get more of is, yeah, it's about to fall, or it could be falling any moment now, so be careful. Likewise, when things are going through a normal down cycle, it's like a weatherman in the middle of a storm. They get so excited and talk about how it's going down and how it could be even worse. Risk is more sensationalized than ever before for a lot of reasons. One is we respond to that. The more they talk about risk in the financial media, the more we're going to pay attention because it plays on that fear. And the more we pay attention, the more advertising they can sell. Now, risk is typically framed in terms of how you manage risk in the financial media, and by a lot of advisors too, is you manage risk by, well, you just buy and sell at the right times, right? You buy low, and when things are high, you sell and you wait for them to go back down. And there are a lot of people that will sell you strategies promising that. Or risk management is framed by, you know what, just buy this right strategy, and because of these benefits, it will take all the risk away. And then risk is looked at as only defined as something that is just about going down. Just about having something go down in value is how risk is generally defined by the financial media and financial salespeople. If you follow that mentality and fall victim to it, that's reckless decision making, and that could be the difference between profit and loss and creating the retirement that you want. Let's talk about another big risk that is talked about but not really focused on near enough, and that is two things. One is longevity. According to economist Andrew Scott in the 100-Year Life, and we've had him on this show, a 40-year-old today statistically has a 50-50 chance of living past age 95. A 60-year-old today has a 50-50 chance of living past 90. Now realize these numbers are not taking into account social economic conditions and health conditions. So if you skew to the high side and you plan on retiring around age 60, you got a 30, maybe 40-year timeline that you got to plan for. Now, why is that a big risk? Because of the second part of that equation, which is inflation. Inflation is a huge risk. So let's look at spending $7,000. Okay, if we were spending $7,000 a month on retirement, well, at a 3% inflation rate, in 30 years, that $7,000 would have the buying power equivalent of about $2,900. That's about a 59% reduction. Now, if you use a 4% inflation rate over those 30 years, that $7,000 a month really is going to have buying power of about $2,158, or a decline of about 69%. The fact that you are going to be living longer in retirement and we have this inflation menace that we have to manage. If you avoid short-term investment risk, you are inherently buying long-term lifestyle risk. So it's how do we find the balance in that? So we have to figure out how to manage this risk because we know we can't just simply invest in cash or buy things that don't have some inflation hedge to them if we hope to be able to maintain our retirement lifestyle. So we got to figure out how to manage this big boogeyman of risk. And that's what we're going to start to do on the show today.
Huh?
What does that mean?
Well, in the What's That Mean segment today, I want to define some very basic terms so we can all be on the same page. There are a lot of crazy terms when you start to get into portfolio management, so I want to make sure we all have a general understanding. The first one I wanted to find is, okay, what exactly is an index? We've heard that term before. So an index in financial markets is a statistical measure of a change in securities markets. In the case of financial markets, an index consists of a hypothetical portfolio of securities representing a particular market or segment. As an example, the S&P 500 index is a very broadly based index that people know. It's meant to represent the United States equity markets, but you cannot invest directly in the index. Now, you can buy products that invest in the index. You could go buy the individual stocks, but it's really a statistical model maintained by the Standard & Poor's Corporation. Likewise, there are indexes for particular sectors of the market, whether it's international, the U.S. Aggregate Bond Index, the Small Cap Index. They can slice and dice it any way they want. So when we refer to an index, we're just referring to a representation of a certain segment of the market. For the basis of our discussion here, we'll refer to the S&P 500 for U.S. stocks, and we will refer to the U.S. Aggregate Bond Index for bonds, which are the two largely known indexes in those areas. The second term I want to make sure we all understand is something called standard deviation. Now, I did not like statistics very much in high school, and this is a statistical term. Now, I remember when I was doing my studies at Wharton for the Certified Investment Management Analyst certification, we had to memorize the formula for standard deviation and calculate it on one of the exams, which was a bear. But for our terms, this is how finance people define risk. Standard deviation simply measures the variability of returns around an average. So as an example, last week we looked at history and said, okay, equities represented by the S&P 500 index historically had an average annual return of 10.2%. Well, we all know you don't get that average. That's an average of a lot of different numbers. And what standard deviation measures is the variability around that average return or that average temperature of the U.S. stock market. Best way to explain it is to give you an example. So if we take where I live, Fort Worth, Texas, the average temperature in Fort Worth over a year's time historically has been 65 degrees Fahrenheit. Now, San Diego, as a comparison, its average temperature over a year historically has been 63 degrees Fahrenheit. So they're pretty close. So if you just looked at the average temperature, you would assume that, hey, living in San Diego is just like living in Fort Worth, Texas, temperature-wise. But anybody that's been to both places in different times of the year realize it's not anything close to being similar. So San Diego, as an example, in September has its high average temperatures. That's the hot season in San Diego, where it's very hot. It's an average of 76 degrees on the high end. So 63 is the average, but on the high end, in September, it can get up to 76 degrees. Contrast that to Fort Worth, Texas, whose hottest month is August, where it can go from 65 on average to 97 on average. That's a lot hotter than San Diego's average high of 76. Flip that around. In December in San Diego, the low average is 49 degrees. In Fort Worth in January, the low average is 33 degrees. So although the average temperatures for Fort Worth and San Diego, 65 for Fort Worth, 63 for San Diego, pretty close, right? The high for Fort Worth can get way up to 97 degrees in the summer, whereas San Diego goes up to 76. On the low end, Fort Worth can get down to 33 degrees on average, and San Diego goes down to about 49 on average. So although the averages are very close, Fort Worth, in this example, would have a much larger standard deviation because the actual temperature that you felt would vary a lot more around the average. That's how financial people measure risk, is how much variability there is on the ups and downs of whatever asset class we're looking at. So that's essentially what standard deviation is. The last term I want to identify is correlation. Another statistical term. I'm sorry, man, it's a lot of math. It's math heavy. It's geek episode. Correlation is really important when finance people look at building portfolios or investing. They know the average annual return, which is important of asset classes. And then they need to know the standard deviation, how volatile those asset classes are. And then they need this last piece, which is called correlation. So correlation is a relative term. So what it does is it measures, okay, when investment A goes up, how correlated is investment B? So it's relative. It's always comparing to something else. So if investment A goes up 10% and investment B always goes up the same amount or down the same amount, so they would be called perfectly correlated. They always move together, okay? Or if investment A went up and investment B always went down by the same percentage, they were totally negatively correlated, meaning that they always moved in opposite directions, sort of like a seesaw. Most of the time, you have things that move sort of in tandem, but not 100% correlated. And they use this statistic to help build that asset allocation, that pie chart that you see probably on your 401k. So that's another important term when we're talking about how finance people build portfolios based off of asset allocation. We're going to get all into that right now that we've defined these terms. So let's get to the practical planning and go deep into managing risk when you're investing for retirement. Welcome to the practical planning segment, and I want to refer back to the quote at the beginning of the show by Charles Duhigg. Between calculated risk and reckless decision-making lies the dividing line between profit and loss. And that is an important perspective to keep when we're trying to figure out how much risk are we taking in our investment portfolio. Are we being calculated in the risk using sound fundamentals and data that we've gotten and wisdom that we've gotten over time? Or are we just sort of flying by the seat of their pants and just making decisions based on advertisements or how we're feeling emotionally at the time, or just simply intuition? I see a lot of intuition, so I want to make sure we dive into this. So the first place we need to start is to talk about the huge disconnect between investment professionals and people. So people, you and I, and everybody else, we think of investment risk typically as losing money. Makes total sense. I don't want to lose money. I've worked hard for the money that we've accumulated over time. Losing money is the big risk, right? Or jeopardizing our retirement goals. For the most part, people are more concerned about what their wealth can do for them in terms of creating retirement than they are about optimizing their portfolio. If they really get down to it, they just want to make sure that they're okay and that they don't run out of money. Well, investment people don't think that way. We look at, traditionally, risk as standard deviation or variability, because the whole basis for how portfolio construction is founded on is focused on average returns of an asset class, standard deviation of that asset class, and the correlation between other asset classes, and then we build an asset allocation around that. So we're going to talk about how finance people build portfolios, and then we'll dive into, is it right for us? Is it right for you if you're trying to retire? Or is there some disconnect because you probably care more about your life and feeling confident about the future, whereas an investment professional, the model cares more about optimizing the statistics of it all. So we're going to dive into that. And then once we understand how finance people do it, then we'll get into, does this make sense for you when you're trying to create a great retirement? But first, we got to know what the finance people think. So when we're talking about investing, whether it's in a piece of real estate, bonds, or stocks, there are two major types of risk that we have to deal with. First is specific risk. So what is specific risk? Well, that's the risk specific to the particular investment. That could be risk in the company involved, risk in the sector. If it's a medical drug company, there's risk in medical drugs, whether it's healthcare reform or price controls or whatever. So that's a risk specific to that sector. It could be execution risk. Does the management of the company execute their business plan well? Or if they execute poorly, that's going to affect the investment in that specific company. There's interest rate risk. Many industries and bonds, as an example, are very sensitive to interest rates. If they go up or down, it could hurt the value of that particular investment. That's a specific risk. There's credit risk. That can change over time. There's regulation risk. What happens if regulations come in? That could hurt a particular company or a particular asset. There's currency risk. There's political risk. There's all these different specific risks. Well, in finance theory, these specific risks can all be eliminated through the diversification of assets. So how do you eliminate, say, company risk? Well, if you buy a lot of different companies, the risk of any one individual company can be eliminated or controlled, and so forth for all those specific risks. So diversification is the way that you go through eliminating or minimizing all these specific risks. That's the logic of buying, say, the S&P 500 index or something that mirrors it, or buying a very diversified portfolio, is that you eliminate the effect of one individual company. Now, yes, you eliminate the risk of that, but you also eliminate the upside of the outperformance of any one specific company. So if you are successful in diversifying within an asset class or in a portfolio, what you're left with is systematic or market risk. Now, you can't eliminate systematic or market risk because let's say you eliminate all those specific risks for stocks and you buy something that mimics the S&P 500 index, you still got the market risk, right? It still goes up and down. And there's not really any way of eliminating that, but you can start to understand it better, which allows you to manage it a little bit more, and we're going to get into that. So how do you manage this market risk? So we talked about standard deviation, and that measures the variability up and down. So let's just give you an example. So if we look at equities represented by the S&P 500, last week we looked at history and said over the last 50 years, the S&P 500 had an average of about 10.2%. But we also know what its standard deviation is, how much it varied around that average. So the standard deviation over that period of time is around 18%. So what does that mean? Well, I don't want to get all geeky on here, but I'll explain real quickly. So if it's had an average return of 10.2% and the standard deviation is 18, statistically, over time, 67% of the return experience should be one standard deviation around that average. As an example, if the average return is 10.2%, one standard deviation in both directions means roughly 67% of the time, you would have between a negative 7.8% return and a positive 28.2% return. And then two standard deviations should encompass about 95% of the returns that you receive in the stock market in this instance. And then there are standard deviations for the bond market and even for the cash or the 3-month treasury bill, which we're using as a cash or risk-free rate of return. That is the measure that is used by finance folks to build portfolios. Okay, we know we have these average returns, and then we know what the standard deviation is, and then we still need one more piece, and that's correlation. That's, okay, well, if I mix cash, bonds, and stocks, how do they move together? When stocks go up, what do bonds do? And what do cash do? What does cash do? When bonds go down, what does cash do? Or what does stocks do? They start to understand the relationship between whatever asset classes. And we're staying really simple here, but I've seen asset classes broken down between small cap, large cap, growth value, international emerging markets, all over the place. So you can make this really complicated. And the reason they want to know these statistics all comes from what modern finance is based on, which is something called modern portfolio theory. Modern portfolio theory was developed by Harry Markowitz back in the early 1950s, and he actually won a Nobel Prize for the modern portfolio theory. And its premise is basically, for any level of risk, you want to minimize or maximize the level of return at any given level of risk. And then flip side, for any minimum risk level, you want to maximize the return. And for any return objective, you want to minimize the level of risk. So that's what a rational person would do. They wouldn't take more risk than necessary, and they wouldn't give up return that they should be able to get at a given level of risk. So it's about maximizing your potential returns or minimizing your risk. You're always going to be rational, is what it's based off of. And by understanding the average returns of asset classes, their standard deviation, and how they work together, what Harry Markowitz found was, wow, if you start to blend these together and you put them in this statistical model called an optimization engine, it will say, well, if you want this amount of risk, then you should have this much in cash, this much in bonds, and this much in stocks. Well, but if you want this much in risk, then it'll spit out the pie chart that maximizes your potential returns for a given level of risk. And that's called an optimizer. And that is what everything is driven off nowadays. If you go to Vanguard or Schwab or almost anywhere, if you go to your 401k and you fill out a risk tolerance questionnaire and they come up with a pie chart, it's going through some type of engine like this using those three basic statistics that Harry Markowitz incorporated in this modern portfolio theory. So in the early 70s, there was a Brinson Biebauer study that measured the performance of institutional accounts to try to get an idea of where the variability of return could be explained. And what they found was about 91% or 92% of return variability was caused by asset allocation, what your asset allocation pie looked like. Since that time, that study has been reproduced in many ways, but a lot of times it's restated as saying, hey, 92% of your returns comes from your asset allocation. which isn't technically correct, but that's how it's presented most of the time. So that's when that study came out, then modern portfolio theory really started to gain traction as a good foundational risk management portfolio construction model for institutions. Then, I know this seems a little bit boring, but it's important to understand some of this history. Then, in 1974, the federal government passed the Employee Retirement Income Securities Act, ERISA, which established minimum standards for pension funds in the private industry of managing assets prudently. It established, hey, people that are managing these assets, whether it's in a pension fund or managing them on the behalf of someone else, they have a legal standard that they have to be prudent in how they do it. And so that put a lot of risk on people that were managing assets. It put risk on the boards of pension funds and institutions, because if they screwed up, they could be in trouble with the federal government. That wouldn't be cool, right? And that helped solidify using modern portfolio theory, asset allocation as sort of a safe harbor. Hey, if I follow this process, which I got this Nobel guy back here, Harry Markowitz, if I follow this process, it's hard for them to say I didn't do a good job. So that helps solidify asset allocation and using modern portfolio theory for building investment portfolios. Now, fast forward a little bit to the mid-'80s when we have IRAs and 401ks coming out in the rise of the investment profession. Well, they all work for major financial firms and they want to serve clients, but they also want to protect themselves from a risk standpoint of mismanagement of client monies. And that just helped asset allocation become the model that advisors use with their clients. One key element that we hinted on a little bit earlier that we need to address is, okay, how do we know what our risk tolerance is? How do we know where we fall on the risk spectrum so this optimizer machine can spit out the right portfolio? And I've talked about this before, but we'll talk about it again here because it's in a broader context. So we need to figure out what risk level we're trying to maximize returns for. So the way that's typically done in the industry is by a very broad-based, are you conservative? Are you moderate? Or are you aggressive? Those boxes you have to check on account forms. That can help determine, okay, what your pie chart should look like. So they use these broad-based terms, but then there are these risk tolerance questionnaires. And my guess is if you had a 401k or you work with an advisor, you probably have filled one of these out. They're going to ask questions like, okay, how old are you? What is your time horizon in terms of investing? Is it 1 to 2 years, 3 to 5 years, or 10 years plus? They may ask you some attitudinal questions about, well, if this happened, would you sell everything or would you hold tight? And they may ask you to pick just some random portfolios from a laundry list. They'll ask you about whether you're contributing or withdrawing money. And then what they do with each one of these questions, what you don't see is on the back end, they assign a number point to whatever decision you made. So each of those questions has a numerical value based on your answers. And then it takes the sum of the numerical value of that questionnaire, and it needs that because that's how they put it into the optimizer to say, this is what your asset allocation or your pie chart should look like. So it's trying to measure what your risk tolerance is. Now pay attention to these words. Once it's identified your risk tolerance, then it will build a asset allocation to maximize your return for that level of risk tolerance. Now, on the surface, that sounds really smart, but there are some problems with that. Let me restate that same statement in a slightly different way. If you allocate the pie chart that is recommended, that is trying to maximize returns for your given level of risk tolerance, you have virtually assured, statistically, that you will experience the maximum amount of pain from a volatility standpoint that you say you can handle. So you've just positioned yourself to statistically anyway, position the maximum amount of risk that you say you can handle. So you intentionally put yourself to experience the worst that you think you possibly could handle, statistically. Let me state that even blunter, and I've done this before. If I'm standing in front of you and I say, I could probably tolerate you punching me in the face 5 times, I could probably tolerate it. I'm not saying I'd like it, but I could tolerate it. That's my risk tolerance. It doesn't mean that I want you to do it. So these risk tolerance questionnaires are woefully inadequate in determining what type of risk you should take because, one, they can't measure it reliably. And if they could measure it reliably, then they're going to position you to experience the worst that you think you can handle and still live. And then lastly, it has nothing to do with the life goals that you want to set as a family. It's not tied to your goals at all. And another problem with this entire structure of using risk tolerance, then standard deviation, then average returns, and then correlation to build this asset allocation is this is an institutional approach of managing risk. And whether we agree with modern portfolio theory and whether it's exactly correct or whether there's some problems with it, it doesn't really matter. But what's different than a pension or an institution and you and your husband or you and your wife? Well, what's the investment time frame for an institution? Technically indefinite. They could technically live forever if they're well managed. What's the investment time frame for you? Well, if you're 60, the investment time frame is, well, maybe 30, 35 years, during which time you may be drawing money from the assets, during which time you're a lot more emotional than an institution because you realize this is all you got and it's got to last for the X number of period of time in your life. It doesn't match what you're trying to accomplish in your life. Most people, well, real people, they think of risk as I don't want to lose money because it will hamper me from achieving my life goals that I want. So if you're approaching retirement, it's about how do I position myself best to reach retirement or achieve all these spending goals, these needs, wants, and wishes that I've come up with or we've come up with as a family. Not achieving those is what risk is to a person. It has nothing to do with risk tolerance. Tolerance and matching some pie chart just because of a 5 or 6 questionnaire you've completed. Now, it's important, though, to have this framework of modern portfolio theory and asset allocation because we need to have a framework that has some academic depth to it to make decisions because we don't want to be reckless decision makers. We want to take calculated risks, and modern portfolio theory and asset allocation help us in doing that. But it's not the entire story, and that's what we're going to talk about in the next installment of Investing for Retirement.
On your marks, get set.
Hey, welcome to the Smart Sprint segment where we take a little baby step in creating a great retirement and creating a great life. So in the next 7 days, what I would like you to do is get a read on what the asset allocation is for your portfolio. How much do you have in stocks, bonds, and cash with your investment assets? We don't have to go deeper than that right now. Let's get that number so you understand what your asset allocation is. And then start to ask yourself and noodle on why. Why is it that? Is that a calculated risk to serve the goals that I have for my family? Or is it reckless decision making? Hey, welcome to the Happy Lab. Well, I'm just going to start off and tell you that I am happy that I got through that risk discussion. I think in a way that you can understand that's not too shallow, but not too deep. There are So many rabbit holes we could dive down, but I want to make sure you get the big important points so you can be a better investor. So I am happy I got through that. Hopefully, I did it in a way that was really valuable for you. The next time you're struggling with a complicated subject that you really need to communicate, get to the big points and tell stories. It always helps, and that will make your life a lot easier. So Farrell left a comment on the show notes for last week's episode that you can find at rogerwhitney.com/blog. I do show notes for every show to show you where things are and summarize things, but there's a spot at the bottom where you can actually give comments and ask questions and start a conversation. And Farrell's asked, he said, as part of the series, could you comment on realistic expectations of investment returns? In light of the disclaimer, past performance is not indicative of future results. Definitely, we're going to talk about that. And I would like to encourage you to submit your questions on investing for retirement, because we'll have a question and answer episode at the end of the series totally dedicated to this subject. And all you need to do is go to rogerwhitney.com and click on Ask a Question, obviously, and enter your question, and I'll compile those, and we'll have a good question and answer and hopefully some robust conversation. Hey, I so appreciate you listening to the Retirement Answer Man show. Next week, we're going to talk about the rest of the story and how do we deal with a risk when it comes to managing assets to achieve what you actually care about in your life. But until next week, this is Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.